Investing in the bond market can be a great way to build wealth and earn a steady income stream. But before diving in, it's essential to understand the basics of the bond market and its history. The bond market is a financial marketplace where investors can buy and sell bonds. A bond is a loan that an investor makes to a company or government. In exchange for lending their money, the investor receives regular interest payments of the principal amount of the bond when it matures. Bonds have been around for centuries, with the first known bond issued by the city of Venice in 1171. Over the years, they have played a vital role in financing governments and companies. For example, during the American Revolution, the Continental Congress issued bonds to raise money to fund the war effort. In the 19th century, railroad companies issued bonds to raise money to build their networks. And in the 20th century, governments issued bonds to finance wars and post-war economic recoveries. The bond market can be divided into two main categories: government bonds and corporate bonds. Government bonds are issued by national governments, while corporate bonds are issued by companies. Government bonds tend to be considered less risky than corporate bonds, but they also offer lower returns. On the other hand, corporate bonds can provide higher returns but also come with higher risks. One of the key benefits of investing in bonds is that they offer a relatively predictable income stream. The interest payments on a bond are fixed, and the bond's principal amount is returned to the investor at maturity. This makes bonds popular for investors looking for a steady income stream, such as retirees. An additional benefit of bonds is that they can help diversify an investment portfolio. Because the returns on bonds are not directly tied to the stock market, they can provide a measure of stability when stocks are volatile. Bonds are also an excellent way to invest in infrastructure projects, such as highways, bridges, and airports. Municipalities and states often issue bonds to raise money to fund these projects, and investors can earn a return by buying these bonds. However, it is crucial to remember that bonds are not without risk. The value of a bond can decline if interest rates rise, making the bond's fixed interest payments less attractive. Additionally, the investor may not get their principal back if the bond issuer defaults on its loan. That being said, the bond market can be a great addition to any investment portfolio, whether you're just starting out or a seasoned investor. With some research and a good understanding of the risks and potential rewards, you can make a well-informed decision about whether or not to invest in bonds. Another aspect of the bond market to consider is the different types of bonds available for investment. Some of the most common types include treasury bonds. These are issued by the federal government and are considered among the safest investments. They typically have a maturity of 10 to 30 years and pay a fixed interest rate. Municipal bonds. These are issued by state and local governments to finance public projects such as schools, hospitals, and highways. They are often tax-free, which makes them particularly appealing to investors in the high tax bracket. Corporate bonds. These are issued by companies to raise money for operations and growth. They can be an excellent way to invest in industries or companies you are bullish about. However, the risk of default is higher compared to government bonds. High-yield bonds, also known as junk bonds, these are issued by companies that have a lower credit rating and are considered to be higher risk. They offer higher yields than other bonds to compensate for the increased risk. Another vital factor to consider when investing in bonds is the bond rating. Bond rating agencies such as Moody's and S&P rate bonds on a scale from A to D. The higher the rating, the lower the risk of default and the lower the interest rate the issuer will have to pay. When investing in the bond market, it's also essential to understand the concept of duration. Duration is a measure of a bond's sensitivity to changes in interest rates. Longer-term bonds have a longer duration and are more sensitive to interest rate changes than shorter-term bonds. If interest rates rise, the value of longer-term bonds will decrease more than the value of shorter-term bonds. In addition to individual bonds, investors can also invest in bond funds, which are portfolios of bonds managed by professional fund managers. Bond funds offer the advantage of diversification, as they can hold various bonds from different issuers and with varying maturity dates. They also provide the convenience of buying and selling shares, just like stocks. Finally, it's essential to remember that bond prices and interest rates have an inverse relationship. When interest rates rise, bond prices fall, and when interest rates fall, bond prices rise. Therefore, it's crucial to understand the interest rate environment when making bond investment decisions. Overall, the bond market can greatly diversify your portfolio and earn a steady income stream. By understanding the different types of bonds available, the bond ratings, duration, and the interest rate environment, investors can make well-informed decisions about whether or not to invest in bonds and how to structure a bond portfolio that meets their needs. Another essential factor to consider when investing in the bond market is the issuer's credit risk. Credit risk refers to the risk that the bond issuer will default on its obligations to pay interest and return the principal. For example, the credit risk of a U.S. Treasury bond is considered to be very low, as the federal government has a strong track record of making interest and principal payments on time. In contrast, the credit risk of a high-yield bond issued by a small, speculative company is considered to be much higher. To manage credit risk, investors can invest in bonds with high credit ratings or bond funds that spread the risk across a diversified portfolio of bonds. They can also invest in bonds that have been insured against default, known as insured bonds. These bonds have an insurance policy that will pay the investor in the event of default, reducing the credit risk. Another important aspect of the bond market is the secondary market, where investors can buy and sell bonds that have already been issued. This market allows investors to buy bonds at a discount or premium to their face value, depending on the current market conditions. For example, suppose interest rates have risen since a bond was issued. In that case, the bond's price will fall in the secondary market as the fixed interest rate on the bond becomes less attractive. Another critical concept to understand is yield, which refers to the return an investor earns on a bond. The yield on a bond is often expressed as a percentage of the bond's face value. It can be calculated using the bond's coupon rate, the frequency of interest payments, and the market price. For example, if a bond has a face value of $1,000 and a coupon rate of 5%, and the bond is trading at $950, the yield to maturity for the bond is 5.26%. In summary, the bond market is a vast and complex financial marketplace that offers investors various investment opportunities. It is essential to understand the basics of how the bond market works, the different types of bonds available, the credit risk of the issuer, the secondary market, and the concept of yield. By doing so, investors can make well-informed decisions about whether or not to invest in bonds and how to structure a bond portfolio that meets their needs. It's also important to note that various macroeconomic factors, such as inflation, GDP growth, and monetary policy affect the bond market. For example, suppose inflation is expected to rise. In that case, bond prices are likely to fall as the fixed interest payments on the bond become less attractive. Similarly, suppose GDP growth is strong and the economy is expanding. In that case, bond prices may fall as investors shift their money into stocks. Monetary policy, the actions taken by a central bank such as the Federal Reserve, has a significant impact on the bond market. For example, when the Federal Reserve raises interest rates, bond prices fall, and yields rise as the fixed interest payments on existing bonds become less attractive. Conversely, when the Federal Reserve lowers interest rates, bond prices rise, and yields fall as the fixed interest payments on existing bonds become more attractive. The bond market is also affected by global events such as political instability, natural disasters, and trade tensions. These events can create uncertainty, leading to a flight to safety and pushing bond prices up and yields down. In conclusion, investing in the bond market can be a great way to earn a steady stream of income and diversify your portfolio. However, it's important to understand the basics of how the bond market works, the different types of bonds available, the credit risk of the issuer, the secondary market, and the concept of yield. Additionally, it's necessary to keep in mind the macroeconomic and global events that can affect the bond market and their impact on bond prices and yields. Research and consulting a financial advisor before making investment decisions is always a good idea. Another critical concept to remember when investing in the bond market is the concept of credit spread. Credit spread refers to the difference in yield between a risk-free bond and a bond with a lower credit rating. For example, a U.S. Treasury bond yield, considered a risk-free bond, may be 2%. In contrast, the yield on a corporate bond with a lower credit rating may be 5%. The credit spread is the difference between the two yields, 3%. Investors can use credit spreads as a tool to measure the level of risk in the bond market. A higher credit spread indicates that investors demand a higher return for the increased risk of investing in bonds with a lower credit rating. Conversely, a lower credit spread suggests that investors accept a lower return for the decreased risk of investing in bonds with a higher credit rating. Another important concept to understand is the concept of the yield curve. The yield curve is a graph that plots the yields of bonds of different maturities. Typically, the yield curve slopes upward, meaning that the yield on longer-term bonds is higher than that on shorter-term bonds. This is because investors demand a higher return for the increased risk of investing in longer-term bonds. However, in some cases, the yield curve can be inverted, meaning that the yield on shorter-term bonds is higher than that on longer-term bonds. An inverted yield curve is often seen as a sign of an impending recession. Another critical aspect of the bond market is the concept of bond liquidity. Bond liquidity refers to how easily a bond can be bought or sold in the market. Some bonds, such as U.S. Treasury bonds, are considered highly liquid as they are widely traded and have many buyers and sellers. In contrast, some bonds, such as municipal bonds, are considered less liquid as they are not as widely traded and have fewer buyers and sellers. Investors should consider the liquidity of a bond before investing in it, as it can affect the ease and cost of buying or selling the bond. In conclusion, the bond market is vast and complex, with many different concepts and factors to consider when investing. It's important to understand the concepts of credit spread, yield curve, bond liquidity, and the macroeconomic and global events that can affect the bond market. As always, doing your own research and consulting a financial advisor before making any investment decisions is essential. Thank you for visiting my finance YouTube channel, Wealthy Ways, and for taking the time to learn about investing in the bond market. I hope you found our discussion informative and engaging. Remember that investing in the bond market can be a great way to earn a steady stream of income and diversify your portfolio. Still, it's important to understand the basics of how the bond market works, the different types of bonds available, the credit risk of the issuer, the secondary market, and the concept of yield. Additionally, it is crucial to keep in mind the macroeconomic and global events that can affect the bond market and their impact on bond prices and yields. Remember to like, comment, and subscribe to our channel for more informative and engaging content about finance and investing. We appreciate your support and look forward to continuing to provide valuable insights and tips to help you reach your financial goals.